Traditional costing, also called volume-based or plant-wide costing, treats overhead as a single lump that is spread over all products using one simple base, such as direct labor hours (DLH) or machine hours. Think of it like using a single faucet to water a garden. Every plant gets the same amount of water per hour of labor regardless of its true water needs. Activity-based costing (ABC) breaks the overhead into many smaller activities, e.g. machine setups, purchase orders, inspections. Each activity consumes resources because of a specific cost driver, a measurable cause and effect factor. This is like assigning each garden plant its own watering schedule based on sunlight, soil type, and size rather than using a one-size-fits-all faucet. Identifying cost drivers in ABC starts with asking what makes this overhead happen. Common drivers include: number of machine setups captures the effort to change tooling. Number of purchase orders reflects the administrative work to buy components. Number of inspections measures quality control effort. Number of material moves records material handling workload. In traditional costing, the driver is usually chosen for convenience, e.g. DLH, and may have little logical link to the actual consumption of overhead. Resulting viewpoint ABC provides a cause and effect map linking activities to products, while traditional costing offers a broad average view that can hide cost distortion. Traditional plant-wide pool. Gather all overhead costs, for example utilities, depreciation, supervisor salaries, into one big bucket. Choose a single allocation base, most common total direct labor hours or total machine hours. Compute the overhead rate. Plant-wide overhead rate equals total overhead divided by total allocation base. Apply the rate to each product. Allocated overhead equals overhead rate times product's base. ABC pools. Identify activity groups. Each group represents a distinct type of work. For example, setup, order processing, quality inspection. Accumulate costs for each activity group into separate activity cost pools. Select a cost driver for each pool that best measures the consumption of that activity. Compute activity rates. Activity rate sub K equals cost in pool sub K divided by total driver units sub K. Assign costs to products by multiplying each product's driver usage by the appropriate activity rate. Key differences. Number of pools, one versus many. Allocation base, single generic versus multiple specific drivers. Accuracy, ABC reduces the averaging error, especially when products differ widely in complexity. Explanation: step-by-step numerical example of activity-based costing calculation. Company X produces two products: widget A high-tech and widget B simple. Overhead for the year equals $600,000. Step 1: identify activities and drivers. Setup cost pool $200,000. Driver equals number of setups. Order processing cost pool $150,000. Driver equals number of purchase orders. Inspection cost pool $250,000. Driver equals number of inspections. Step 2: collect driver totals company-wide. Setups: 40 total. Widget A equals 30, widget B equals 10. Purchase orders: 200 total. A equals 120, B equals 80. Inspections: 500 total. A equals 350, B equals 150. Step 3: compute activity rates. Setup rate equals $200,000 divided by 40 equals $5,000 per setup. Order processing rate equals $150,000 divided by 200 equals $750 per order. Inspection rate equals $250,000 divided by 500 equals $500 per inspection. Step 4: apply rates to each product. Widget A. Setup cost equals 30 times $5,000 equals $150,000. Order cost equals 120 times $750 equals $90,000. Inspection cost equals 350 times $500 equals $175,000. Total ABC overhead for A equals $415,000. Widget B. Setup cost equals 10 times $5,000 equals $50,000. Order cost equals 80 times $750 equals $60,000. Inspection cost equals 150 times $500 equals $75,000. Total ABC overhead for B equals $185,000. Step 5: add direct costs, for example, direct material and labor. Direct cost A equals $300,000. Direct cost B equals $200,000. Unit cost: assume 10,000 units A, 20,000 units B. A equals $300,000 plus $415,000 divided by 10,000 equals $71.5 per unit. B equals $200,000 plus $185,000 divided by 20,000 equals $19.25 per unit. The ABC calculation shows that widget A bears a much larger share of overhead because it requires many more setups and inspections. Step-by-step numerical example of traditional plant-wide costing calculation. Using the same company X data but with a single plant-wide base, direct labor hours. 1. Gather totals. Total overhead equals $600,000, same as before. Total direct labor hours for the year equals 30,000 hours. A equals 12,000 hours, B equals 18,000 hours. 2. Compute plant-wide overhead rates. Overhead rate equals $600,000 divided by 30,000 hours, which is $20 per direct labor hour. 3. Allocate overhead to products. Widget A overhead equals 12,000 hours times $20, which is $240,000. Widget B overhead equals 18,000 hours times $20, which is $360,000. 4. Add direct costs, same as an ABC example. Direct cost A equals $300,000. Direct cost B equals $200,000. 5. Calculate unit costs, 10,000 units A, 20,000 units B. For product A, 300,000 plus 240,000 divided by 10,000 equals $54 per unit. For product B, 200,000 plus 360,000 divided by 20,000 equals $28 per unit. Observation: traditional costing spreads much more overhead onto the low-complexity product B and undercosts the high-complexity product A because it ignores the true drivers such as setups and inspections. Explanation: comparative effects on unit product cost and profitability margins. Unit cost widget A equals $71.5 for ABC result and $54 for traditional result. Unit cost widget B equals $19.25 for ABC result and $28 for traditional result. Gross margin selling price $80 for A and $30 for B for ABC result. A equals $8.5, 10.6%. B equals $10.75, 35.8%. For traditional result, A equals $26, 32.5%. B equals $2, 6.7%. Profitability shift. Under ABC, widget A looks less profitable than under traditional costing, while widget B looks more attractive. This information can change strategic decisions such as focusing on high-margin B or improving A's process efficiency. Decision relevance. Managers using ABC are less likely to price undercost a complex product or overprice a simple one because the cost picture reflects the real resource consumption. Bottom line impact. If a company continues to price based on traditional costs, it may lose money on high-complexity items like A while leaving money on the table on low-complexity items like B. ABC helps align price with true cost, protecting margins. Impact of costing choice on pricing, product mix, and make or buy decisions. Pricing, ABC, gives product-specific cost including activity-driven overhead. Prices can be set at a target margin above the true cost, reducing the risk of hidden losses. Pricing, traditional, may lead to one-size-fits-all pricing. Complex products can be priced too low, simple products too high. Product mix with a BC, managers can identify high-cost activities and decide to drop or revamp low-margin products. For example, if widget A's setup cost dominates, the firm may invest in quicker change over technology or discontinue A. Product mix, traditional costing can mask such insights because all products share the same overhead rate. Make or buy, a BC can isolate the cost of each activity, for example, in-house inspection versus outsourcing inspection. If the activity rate for inspection is $500 per inspection, and a supplier can perform inspections for $350, the decision to buy becomes clear. Make or buy, traditional costing would spread the inspection cost across all products, making the comparison noisy and potentially leading to a wrong decision. Capacity utilization, by tracking drivers like machine setups, a BC highlights where capacity is consumed. Managers can schedule production to smooth high setup periods, improving overall efficiency. Strategic implications. Companies that compete on cost leadership often adopt a BC to fine-tune processes. Strategic implications. Firms with stable product lines and low variation may stick with traditional costing because its simplicity outweighs the marginal accuracy gain. Explanation limitations, criticisms, and contexts for appropriate use of each system. Complexity activity-based costing requires many activity pools, driver data collection, and periodic updates, can be time-consuming and costly. Complexity traditional costing, simple one overhead pool, one driver, easy to implement and maintain. Data requirements activity-based costing, detailed transactional data, setup counts, order numbers, inspection logs, often needs changes to ERP modules. Data requirements traditional costing, minimal data, total labor hours or machine hours. Accuracy versus cost trade-off activity-based costing, higher accuracy, especially when products differ widely in resource usage benefit, may be outweighed if the cost of maintaining ABC exceeds the profit improvement. Accuracy versus cost trade-off traditional costing, acceptable accuracy for homogeneous product mixes, or when overhead is a small proportion of total cost. Behavioral issues activity-based costing can reveal costly activities, provoking resistance from staff who see their work being scrutinized. Behavioral issues traditional costing, less intrusive, may conceal inefficiencies. Decision relevance activity-based costing, excellent for pricing, make or buy process improvement, and product line rationalization. Decision relevance traditional costing, adequate for short-term budgeting and broad performance measurement. Scalability activity-based costing, difficult to scale in very large diversified firms without sophisticated information systems. Scalability traditional costing, scales well used by most large manufacturers for internal reporting. Typical use cases activity-based costing, high mix, low volume environments, for example custom equipment, aerospace, job order shops. Typical use cases traditional costing, low mix, high volume industries, for example commodity chemicals, basic consumer goods. Criticism activity-based costing, garbage in, garbage out. If drivers are poorly chosen, results can be misleading. Also, the static nature of driver rates may ignore economies of scale. Criticism traditional costing, known to cause cost distortion, leading to bad strategic decisions, especially in multi-product firms. When to use which, start with traditional costing for baseline reporting. Introduce activity-based costing incrementally for the most expensive or strategically important products. Re-evaluate annually if the cost-benefit ratio turns negative. Consider simplifying back. Conceptual multiple choice, which of the following best describes a cost driver in activity-based costing? At any expense recorded in the general ledger. B, the factor that causes the cost of an activity to be incurred. C, the total amount of overhead allocated to a product. D, the selling price of a product. Answer B, the factor that causes the cost of an activity to be incurred. Conceptual true-false in a plant-wide costing system. Products that consume more labor hours always receive higher overhead allocations than products that consume fewer labor hours. Answer true, because overhead is allocated on a per labor hour basis. Quantitative ABC, use the numbers from the ABC example above, compute the activity rate for the inspection pool, and then determine the total inspection cost allocated to widget B. Solution inspection rate equals $250,000 divided by 500 inspections equals $500 per inspection. Widget B inspections equal 150 times $500 equals $75,000. Quantitative traditional use, the same data set if total direct labor hours are 30,000 and total overhead Is $600,000 what overhead is allocated to a product that used 8,000 labor hours? Solution overhead rate equals $600,000 divided by 30,000 equals $20 per direct labor hour. Allocation equals 8,000 times $20 equals $160,000. Decision-making short answer: a company's product X has an ABC unit cost of $45 and a market price of $55. Its traditional unit cost is $38. Should the firm use the ABC cost for pricing decisions? Explain briefly. Suggested answer: yes, the ABC cost reflects the true resources consumed. Using the lower traditional cost would underestimate cost, potentially eroding margin if the market price does not cover the actual $45 cost.